certainly appreciate this opportunity to address the Economic Club of Chicago. Your organization, founded almost 70 years ago, has a well-established reputation as a valuable forum for discussion of some of the key economic issues facing the Midwest and the nation. Tonight, I hope to continue that tradition by stepping back from the narrower concerns that occupy much of my time to consider some of the fundamental factors that may shape our nation's economic future, perhaps well into the first decade of the 21st century. Ancient soothsayers may have been able to penetrate the future, but unfortunately they chose to vouchsafe precious few tricks of their trade to today's central bankers. The most effective means we have for looking over the horizon is to try to identify which of the forces currently driving our economy are transitory and which are deep-seated and likely to persist in the longer term. One major deep-seated force that we can identify with some assurance is the trend towards an increasing conceptual content of output, the substitution, in effect, of ideas for physical matter in the creation of economic value. The roots of this trend lie deep in human history, but the pace of such substitution probably picked up in the early stages of the Industrial Revolution, when science and machines created new leverage for human energy. Nonetheless, even as recently as the middle of this century, the symbols of American economic strength were our output of such products as steel, motor vehicles, and heavy machinery, items for which sizable proportions of production costs reflected the value of raw materials and the sheer manual labor required to manipulate them. If we do not know how we are doing as a society, we shall not be able to devise appropriate policy responses to changing environments. The proliferation of cutting-edge technologies is making it especially difficult to measure how well or poorly our economy is performing overall. We depend on signals from the marketplace to judge what is adding value and providing utility and what is not. The structure of prices and quantities that derive from free market interactions is a reflection of the relative worth of various goods and services. If people like what they are offered, they will buy. Sales values will rise, and the market value of the capital assets that produce those goods will rise as well. The aggregate market value of goods and services, that is, the gross domestic product, is an especially useful measure of our productive capabilities. Its major component, gross business product, is in effect the consolidated net sales of the economy. These measures are not meant to be definitive measures of the general well-being of a society. Increases in crime and pollution, for example, tend to raise the outlays to combat them and hence to raise the gross domestic product. Depletion of natural resources in the production process adds to business output and gross domestic product. GDP is strictly a measure of economic output, and when measured against labor and capital inputs, a measure of productivity. Whatever its shortcomings, it is by far the best proxy that we have for the growth in our living standards. Our conventional GDP measures for recent years exhibit some indications of a step up in productivity growth. But in December, the Department of Commerce will officially shift the focus to a new measure of economic growth. In so doing, it will adjust for one bias in the current measure and, all other things equal, the result will be that reported growth in output and productivity in the last few years will be shown to be slower than current measurement formulas have been indicating.
What conditions do you think must be met before we can see a further reduction in interest rates?
Those that seem appropriate to the Federal Open Market Committee. Next question.
That's all right. We have around 6 ways of asking this question. Well, the next one I hope will be a little more palatable. Given the increasing globalization of world financial markets, is monetary policy more or less effective than earlier in the post-war period?
That obviously is an issue which we have struggled with for quite a long period of time, because one aspect of the general acceleration and conceptualization of output and globalization, which I mentioned in my earlier remarks, is an even more dramatic change in the proliferation of international finance. The proportion of cross-border claims, whether in currencies or in securities or what have you, has gone up by many multiples of the actual amount of trade that has gone on, which itself has gone up a multiple of domestic outputs. So what we have largely as a consequence of the new telecommunications technology is a veritable explosion in international finance and an increasingly evident amount of cross-border interplay from one economy to the other. One would assume that under those conditions that monetary policy within a specific economy would clearly have far greater ability to manage itself independently of what other policies are doing. And indeed, for the smaller countries throughout the world, that is very clearly the case. And indeed, one can watch, for example, that the Netherlands, for example, which tends to lock itself into the Bundesbank's monetary policy, is effectively interacting in a single market, as indeed so are the Austrians. The United States, however, is still sufficiently predominant that one sees very little diminution of our capacity to implement a degree of policy that we see fit. And one of the reasons for that is that the tools that we have and the sophistication of the overall financial system of the United States is such that we can calibrate as we need to get the desired degree of pressure. And the degree of capability that we have is of such a magnitude that even if, as we indeed are, confronted with very substantial increases in international flows, we just ratchet up our ability and effectively meet the changing internationalization and globalization of the system. So as a practical matter, there has not been, at least so far as I can judge, any meaningful diminution in the ability to implement a full-blown monetary policy. And I must say, I do not envisage that as a problem in the foreseeable future, with the one caveat, namely, I said that the future is extraordinarily difficult to fathom, but to the extent that we can, it's clearly not evident that anything of that nature is there to give us concern.